Good afternoon, everybody, and welcome to Nedgroup Investments 2026 discussion on the budget as presented by the Finance Minister yesterday in Parliament. Overall, it was met with great positivity across market commentators, and certainly progress has been made by the government in, I think, several areas over the past year or so. And this has resulted in the country benefiting from our first credit upgrade in 16 years, a strengthening currency, lower inflation, and a rising economic growth rate. A key emphasis from yesterday's budget was the idea of fiscal discipline, where the government is committed to ensure that they continue to go down a path of reducing debt and increasing expenditure in a measured way. Post the budget speech yesterday, we saw the South African rand strengthen and South African bond yields reduce, both signs that investors looked favorably on what the Finance Minister presented. I'm pleased to introduce our guest speaker today, who is no stranger to Nedgroup Investments and our events, and that is Nicky Weimar, Nedbank's Chief Economist. Nicky always has an amazing insights and the ability to explain key policy and detail in a nice, easy, and simple and understandable manner. So, Nicky, it's really great to have you with us today. Nicky will be spending the next 20 to 30 minutes unpacking key elements of the budget, after which we will have a 20-minute or so discussion around several key aspects. We hope that you will find it interesting and useful and informative. So, Nicky, it's really, really great to have you with us today, and I hand over to you for your presentation.
Thank you, Trevor. It's good to see you as well. Let's talk about the budget. You're quite right, Trevor. We've seen a very positive response to yesterday's budget, certainly in the markets, where it was greeted, I think, with great hope and enthusiasm. And it's been reflected in the price movements and in the movements in the currency. But I think before we head into the details of this budget and what perhaps made the market so excited about the budget, I think it's important to stress that at no point during the budget speech or anywhere in the budget review that the Finance Minister leave the impression that South Africa does not have a fiscal challenge. We have a very significant challenge, and I'll just very quickly remind you of what that is. This first slide here shows you South Africa's budget deficit. So in other words, the extent to which our expenditure exceeds our tax revenue expressed as a percentage of GDP, in other words, expressed as its share of the overall economy. And you can very clearly see that we've been running budget deficits of over 3% of GDP for an extended period of time. That is a very unsustainable level. The next slide shows you, if you look at that yellow line, it shows you really that essentially expenditure has been outstripping revenue for quite some time from government's perspective. What that's led to is a situation where our debt burden has built up quite dramatically. We've gone from, and it's sometimes astounding to look at this graph, that first bar graph there with a little black line across it. It shows you just how our debt burden went from essentially less than 27% in 2009 all the way up to almost 79% last year. So that acceleration meant that we now have a debt burden that is among the higher at a higher level than many other emerging markets. And over this period where debts accelerated, of course, we had one credit rating downgrade after the other. We saw bond yields shoot up. We saw the rand weaken. And we saw the risk premium priced into South African assets rise very sharply. And a key implication for fiscal policy and for ordinary South Africans is, of course, if your debt burden runs away like that, you sit in a situation where essentially government has to consume an ever-growing share of tax revenue just to service the interest on their existing debt, and that means there is far less left to spend on the things that really matter, that make a difference to job creation, make a difference to people's lived experience of the economy, and makes a difference to economic growth itself. And this is what I show you here, is what's happened to debt service cost during that period that debt escalated, where it hit 385 billion rand last year, and consumed over 20% of tax revenue. And as a result, it just meant government had to consistently cut non-interest expenditure. That type of expenditure that really makes a difference to the living standards and the economic performance of a country. So we're still in that position. That's where we were at the end of last year. This is still a very tight budget position. There is very little room for and margin for error. And it is in this context that after the pandemic, government made the decision to tackle this fiscal challenge really in a far more targeted and measured way, and to focus really on sort of two main areas. The first being they were going to do their best to try and unlock faster economic growth, and in order to do that, those are the 4 points they highlighted. They're going to maintain macroeconomic stability, they're going to implement structural reforms, deal with all of these infrastructure issues South Africa have around electricity, logistics, water, and red tape, and try and lessen the drag that places on the economy. At the same time, there was a longer-term aim to build state capacity and to allocate more public funds to public infrastructure. So that was the aim and the purpose behind those measures and those initiatives were really to get the economy to grow a little bit faster and to and really lift the chokehold placed by all the infrastructure issues on economic growth. The other priority for them was to really move fiscal policy into a position where you can start to deal with that debt burden. So the aim was explicitly to reduce the debt burden. First stabilize it and then reduce it. And they were going to do that if in a low growth environment you don't have too many options. You can raise taxes, and they've certainly done that. But ultimately, if you want to bring your debt burden down, if you're not growing rapidly and you've done as much as you can on the tax front, the only thing that is left really at the end of the day is you've got to cut spending. And they did that by focusing on running a primary surplus. In other words, the extent to which non-interest expenditure, they tried to keep that below tax revenue. And here's the thing, they've succeeded to do that, and they've done it for 2 years in a row. So there is some good news coming through there. And what they've also decided to do is to actively and reallocate funds away from consumption expenditure and towards infrastructure spending to just accelerate all these investment reforms and all the structural reforms that is happening out there. And then I think very importantly, during the course of last year, they announced a new thing called the Targeted and Responsible Savings Initiative, where they aim to now finally start to tackle government inefficiency and deal with government waste and wasteful spending in a much more systematic way, in the same way they did with the structural reforms. So that was the aim. We're still in a tight position, but there was a plan. They started to implement this plan. And so at the end of 2025, where are we? What did they tell us in the budget on how we've shaped up? Now, I think Trevor's already run you through some of those things. They have clearly made progress. There is some evidence that they have certainly produced a situation where they've stabilized electricity through structural reforms, where they have at least made some moderate efficiency gains in logistics, in both the railroad and port side of the equation. They've also put through cleared a lot of the legislative hurdles to allow greater private sector participation in South Africa's network industries, both electricity and logistics. There's still some challenges ahead. The water crisis have not been resolved. Local government services are still falling apart in many large municipalities. That is weighing on growth. But But clearly they have something to show on the structural reform side. That was evident last year because the operating environment stabilized. The other thing, of course, they did is they maintained fiscal discipline. Like I said, they run a primary surplus for 2 years in a row. The rating agencies rewarded them for that. And then last year they had the courage of their conviction, and they accepted the Reserve Bank's offer to reduce, let's say it offered the Reserve Bank's initiative to try and reduce the inflation target to 3%, and that made all the difference. What we essentially saw is that the rand came down, the risk premium came down, and it contributed to that sovereign risk rating upgrade we got from S&P Global. So we're in a better place as a result of that. The economy is slowly starting to recover a little bit, but that is still slow going. And then on the actual government and fiscal policy side of the story, what have they managed to achieve? So let's have a look at that. Now here's the budget, right? That is the outcome from last year. That first little column there shows you, the second one rather, shows you the budget numbers. That was what they aimed to achieve last year when they finally got their act together and got a budget out in May last year. Then there are the revisions from the medium-term budget policy statement, and then there's the actual outcome. And what you can see there is that revenue overperformed. To some extent, they got lucky, right? We had a big surge in global commodity prices, particularly in precious metal prices, and that boosted corporate tax and also receipts from royalties. So that made a big difference. That gave them a nice little boost. And then at the same time, the improved financial environment with inflation coming down, interest rates coming down, led to more aggressive consumer spending, and so they collected more from VAT. So all of these things helped revenue to overshoot. They also spent more than they initially budgeted for. They wanted to grow expenditure by 7.5%. In the end, they grew it by 7.9%, but they kept it more or less at that level towards the end of the year. Altogether, you put that together and you're in a situation where they kept the budget deficit steady from the year before at 4.5%. And in fact, they did a little bit better than they initially thought they would. And bear in mind, they did this in an environment where inflation came down very sharply. Remember, government is a key beneficiary from inflation. And the fact that inflation came down to closer to 3% certainly did impact their revenue. So revenue could have probably been even more robust than you see there, was it not for the decline in inflation. So that we ended last year in a better place. Listen, we are not on strong ground. We don't have firm foundations. We still have a very vulnerable fiscal position. But over the last couple of years, we've been slowly eking out small gains. Those small gains have now accumulated to the point where they're actually starting to make a material difference. So coming into this year's budget, we were all interested to see what they were going to do with that revenue overrun. Were they going to give us tax relief? Were they going to spend more? Were they going to just push it all through into debt and reduce the deficit? Those were their choices, or to do a little bit of everything. So what they ultimately decided to do was really a little bit of everything. They continue on the path of deficit reduction, which is absolutely critical. You can see that. They aim to reduce the budget deficit to 4% next year, and then slowly down to 3.1%. If I have to point out something that disappointed me, it was this, that they didn't go for a little bit more of an ambitious deficit reduction path. And in fact, they chose a path that was just slightly above the trajectory they set out in November's mini-budget. So they made a compromise on that front, and they did that really because they calculated into this story that revenue growth will not continue at 8%. The rally in precious metal prices are unpredictable, not something you can rely on, and at the same time, they are now having to budget on much weaker inflation numbers going forward. So inflation is not going to help them anymore, but slightly better economic growth over the next couple of years will provide some support. And then they also opted for continued expenditure restraint. So what did the markets welcome? I think what they welcomed was that the fact that they took this pragmatic route. They are still bringing the budget deficit back to 3%, which is a sustainable level, by the end of the 3-year period. And at the same time, they gave a bit of tax relief, which I think everybody felt was necessary. What form did it take? Listen, it was limited. There you can see, you can look at your taxable income, find yourself in that category. Given that this is Nedgroup Investments, I'm assuming that you're all in the top category there. And your saving over the year as a whole will be just over 6,000 bucks. It's not a huge amount of money. It was collectively just over 15 billion in tax relief that they provided. It really was not dramatic stuff. And there were no changes to the tax rates. There was essentially just an adjustment for the effects of for the effects of inflation for the year ahead. So they gave you an adjustment to all the tax brackets and all the thresholds to the tune of 3.4%, which is their forecast for what inflation will do in 2026. But they didn't provide you with any compensation for the impact of fiscal creep and bracket creep over the last 2 years. So consumers have still handed over a tremendous amount of money to government over the last 2 years. And government hasn't fully rectified that, but at least they gave some tax relief. On the expenditure side, they maintain a fairly disciplined picture. There you see what they want to do with consolidated expenditure. It's going to grow by just slightly over 3%. The most encouraging bit here is that it looks like they're starting to get the public sector wage bill under control. The lower inflation rate will in fact help to accelerate that. And as a share of total government spending, you can see how the public sector wage bill has come down. The bit we all really should be interested in is essentially the non-interest expenditure, because that's what makes a difference to the economy. Now, on this front, their stated goal was to redirect expenditure away from recurrent expenditure towards capital expenditure, fixed investment, infrastructure spending, with the aim of resolving some of the constraints in this economy to unlock faster growth and employment creation. Have they done that? Well, they've very little space to move with. Like, if you look at non-interest expenditure, it's going to grow by about 3.5% on average over the next 3 years. So in line, maybe slightly above the rate of inflation. So there really isn't a lot of space for them to move with. Within that, almost all of it still goes to the social wage. And the social wage still consumes over 60% of non-interest expenditure. So it's still the biggest chunk of expenditure. You can see that it falls off in that last year of their budgeting cycle, which is 28-29. But that's a little bit deceptive, because they did not budget for the extension of the social relief of distress grant for year 2 and year 3 of the medium-term expenditure framework. So where's the emphasis? The emphasis is fully on economic affairs, and the biggest portion of that in the year ahead will go towards infrastructure. I'll show you a little bit more detail on that going forward. Then there is an emphasis on healthcare, which grows by more than the rate of inflation, and as you may have guessed, given the emphasis placed by President Ramaphosa on fighting crime in the State of the Nation address, you also now have public order and safety, which is where policing and the courts fall, growing by more than the rate of inflation. And then everything else is also above the rate of inflation, with only defense and housing lagging quite far behind in the year ahead. On average, over the next 3 years, housing now moves to the top, but of course this is a very small budget function. Environmental protection gets more money. A lot of that is really related to dealing with some of the emergencies we have, some of the emergencies we experienced over the last couple of years, especially the damage related to drought and flooding. And then again, economic affairs and social protection gets a big chunk of the money, and it is above the rate of inflation, but only modestly so. So, on social protection, There you go. They did not budget for a continuation in the social relief of distress grants, so they probably underestimate the rate at which expenditure will grow over the next 3 years. They only extended it for another year, and that is, in other words, another 35 to 37 billion rand that you can add to expenditure in the outer years. But one of the things they pointed out, which I think is very encouraging, is that once they started this task program, this targeted and responsible government program in order to try and get some efficiency gains, they did actually identify a lot of individuals that did not qualify for the SDR grant, so they reduced the number of dependents there. Similarly with the child welfare grant. So they've managed to start to get rid of some of the corruption in the process. They've lessened the number of dependents, although it still remains extremely high, and beneficiaries. And so the outcome is that they believe that if they can get momentum with improving government efficiency, dealing with the fraud and the corruption, and also dealing with some of the wasteful spending, that they can help to bring social grants and the outlays for social grants down to more respectable levels. Then they have undoubtedly managed to redirect more funds to infrastructure. That's probably one of the best messages of this budget. Over the last 3 years, they have grown expenditure on infrastructure by over 40%. But bear in mind, it comes from an extremely low level, only 3.3% of GDP. So it was maybe not so difficult to increase it, but they have moved it closer to 4.5% of GDP. And they aim to maintain infrastructure spending over a trillion rand over the next 3 years. And the focus remains on economic infrastructure with large sums allocated to deal with logistics, energy, and water, which I think we all agree is where the emphasis should be. They're also undertaking reforms, significant legislative reforms, to attract more private investment and private participation in all of these network industries. And there's been some success on that front. A prime example is the fact that as of the start of this year, Transnet has bought in a private company to run Tier 2 at Durban Port, which handles 48% of the country's container traffic. So if you could get some efficiency gains there, bring the cost of doing business down, then that could be good for economic growth, good for future investment, and good for employment creation going forward. So this is a positive story, and there is definite evidence of movement there. The other positive story is while expenditure on fixed investment was the fastest growing item in the budget, debt service cost became one of the slower growing items in the budget after completely blowing out for year upon year upon year upon year. It's still very high. It's still about just over 16% of total government expenditure, but it's expected to slow down quite significantly, and government believes that last year was the peak in debt service cost, and from here on out, we should start seeing it coming down. And that's probably the best news of this budget. It took a lot of sacrifice, and they're going to have to stick at it. They're going to have to stay the course. They're going to have to remain very disciplined in their expenditure and make progress with improving government efficiency. And there you can see that they acknowledge that. They're willing to go that route. That primary surplus show you that. They're going to grow the primary surplus to 2.3% over the next 3 years. And what that really tells you is there's very little space for government to drive growth from a spending perspective. They're going to have to do it the hard way. They're going to have to find efficiency gains. But the best news, I think, for South Africa, and for the potential positive ripple effects, is that at the end of the day, government and National Treasury firmly believes that last year presented a turning point in South Africa's debt cycle. That was when debt peaked, and from here on out, we should see the country's debt burden starting to decline. It will decline very slowly. Like I said before, we're still in a tight position, but this careful management, all these small steps in the right direction has got us to a point where at least we can say we are moving towards sustainability and there is clear evidence of that. So if I had to sum up this budget, it isn't a budget that contains any dramatic moves. There was the little windfall gain of us getting modest tax relief. But overall, this is a budget that signaled to the market we're serious about restoring South Africa's public finances to health, to return them to good health, and to set South Africa on a more sustainable path, and we're willing to slog it out. So hopefully that gives you a sense of what's behind all of it. And with that, I hand back over to Trevor.
Great, Nicky. Thank you so much for that. Very interesting, insightful, and certainly well summarized. I think a good starting point just for a little bit of discussion, and I feel we often go to this point every year, is just on South Africa's economic growth.
Yes.
And at the end of the day, for us to get unemployment down and the economy really growing and all the way down to grassroots, we've got to grow the economy. Now, they have forecast South Africa GDP to grow. It's 1.6 this year, 1.8, and then 2 over the next 3 years. Certainly going in the right direction, better than the one that we eked out for the last few years. However, still not really, I guess, where it can make a material impact. And it was quite interesting. I was looking at some of the numbers which they actually had in the budget, and they were speaking about Nigeria, that for me stood out. And Nigeria's currently got GDP growth of between 4 and 5%. And I was just wondering, just your views on what is Nigeria doing differently to get 4 to 5% versus what we're doing to be 1.5 to 2%, and can we get there ever?
Yes, I mean, if I look at Nigeria, they're coming off a very low base, right? They had all the drama with the central bank, with the corruption, with the political instability, and all of that certainly played a role. And at one point, they were growing almost just as slowly as we were. So they're coming off a low base and they are rebounding. I think, they've made some correct decisions. They've made some wise policy choices and they are reaping the benefit of that. But one of the things we find in the rest of Africa is that it's a far less regulated economy, right? So there is some momentum there. There's some dynamism. There is some, in our case, I think one of the factors that makes it difficult for us to bounce back is that we're very heavily regulated. Government really is, we've seen a proliferation in red tape. They acknowledge that much. But they haven't moved quickly enough to get rid of it. And to allow a little bit of breathing space and basically to allow the economy to be a little bit more dynamic, more adaptable, adjust faster to change circumstances. And if you allow that, I think we could grow faster. There are some economists that have done tests on what's our sort of underlying pulse. Let's assume we had no constraints, right? And it's also there at about 3.5%, right? But unfortunately, we do have constraints. So that's the one side of the story. The other side of the story, I think, is that perhaps one of entrepreneurship, which goes back to red tape and to the cost of starting a business, right? That's much more dynamic in Nigeria than in South Africa. That's one of the reasons they might bounce back that much quicker and so much more convincingly than we do. And then I think the final thing has maybe got to do also with measurement. Perhaps Nigeria's growth rate is slightly overstated and ours are slightly understated. So maybe the margin is not quite as large as the official numbers suggest.
Great, Nicky. Thanks for that. I guess slightly changing tact and speaking about something that's certainly very much on people's discussions and agendas and in the news is AI and the move towards that in terms of productivity affecting business, etc. So certainly globally, we see governments and large private companies spending billions now on technology and these battery farms, etc., and really building a strong digital infrastructure within certain economies. In terms of South Africa and the budget that was presented yesterday, do you think South Africa is taking this AI opportunity seriously? And where do you think public-private partnerships could really move the dial in this area?
I think it's still very much early days for government. They've put 3 billion aside to put in digital infrastructure, so they have made an allocation in rands and cents to that purpose. They believe that there could be benefits for them in terms of tax enforcement, in terms of dealing with some of the issues that they have, in terms of ghost workers, in terms of illegal recipients of certain government services, to identify them. Maybe AI could be used in a constructive way to do that. And just generally to make government more efficient, the processing of passports, of driver's licenses, of all of those sorts of things could potentially be improved. However, I think it's very early days in South Africa. I don't think there's any sort of coherent strategy to implement artificial intelligence, certainly not in the public sector. As we all know, in the private sector, we're all looking at it. We're all looking at ways and means of implementing it. But again, what I think it lacks is a coherent, determined drive to make AI more central to the way we interact and work on our computers, the kind of work we're doing. And so I would say that artificial intelligence and the tool, although very impressive, is still very fractured. And in fact, I think that is the situation worldwide. And you've seen China have been able to use AI with a very different strategy than America in a very constructive way in manufacturing, where you've got fully automated plants. Literally, an engineer arrives in the morning to check the machines and leave at night to check the machines, and the goods go on a conveyor belt to the trucks and from the trucks out to the ports. Now, so we're very far behind as far as that's concerned. But I don't think we're the only ones. Everybody's grappling with how will you use this technology. And of course, in your world, in the investment world, that's a big issue because artificial intelligence and companies in that space, we have seen their share prices rise very, very sharply. And they've still not found a way to translate that into genuine productivity gains and genuine efficiencies for companies. So I think it's globally still a fractured story, but we know that you just go back to the dot-com crisis, right? Although we had the bursting of that bubble, that technology survived. And most of it survived. And at the end of the day, did make a difference to productivity and led to the great moderation, where for over a decade we had low inflation, low interest rates, and rapid global growth. So it's not, I think it's a very useful technology, but I think you do need to focus on it. You need to integrate it into your decision making, and you need to drive it to get the most out of it. And I think on that score, the whole world's grappling with how do you do this.
It's interesting. I mean, I think we see on the roads in South Africa every day the Chinese cars, re your comments. I mean, we just see them massively taking over. I think something like 40% of new car sales now in South Africa are Chinese.
Yes.
And I was reading an interesting article. Chinese car manufacturers are about 5 times more efficient at producing cars than the Europeans like BMW, Audi, etc. And hence their costs of production and pricing is just so much lower. So yeah, it's going to be interesting. Nicky, just one of the, for me, key things that came out in the budget speech yesterday as well, and I think President Ramaphosa spoke about it in his Sona address, was it last week or the week before,
Yeah.
is just with the municipalities, where we know that there's been massive inefficiency in a lot of the municipalities. Some are, of course, better than others in terms of them allocating their budget, spending it appropriately, lack of not corrupt, etc. And it seemed like there was a very much a shift yesterday in the budget in the way that government is approaching the municipalities, from just being oversight and handing them a budget every year to actually like structural intervention, I think they called it, where they're going to be much more monitoring each municipality, how they spend their money, what each investment's return on the investment is, etc., which I think is a positive move. And I think they're going to very much do it municipality by municipality. So if you have a track record of efficiency, it's less involvement, but the poor ones much more hands-on. Just your comments and insights on that shift in policy.
So some of the measures they're implementing there is in line with the STARS policy, this Targeted and Responsible Savings Initiative. Okay, so some of that relates to that. They're using very similar sort of thinking that they applied to social grants. But another portion is actually legislative, yes, that they're now saying, listen, we're going to ring fence some of your earnings, whether it be through, rates and taxes and service charges for things like water, electricity, and we're going to ensure that it goes towards, firstly, investment in critical infrastructure and the maintenance of that infrastructure. So that is actually a very significant intervention. It could be very meaningful. Interesting, I don't know how much time we have, but an interesting tidbit I can tell you is we've noticed on the credit side, obviously as working for a bank as an economist, you watch credit very closely. We've noticed on the credit side that there is a very significant disparity between the demand for credit in the Western Cape and the demand for credit in Gauteng. And also in the nature of that credit. Where in the Western Cape, people use credit for the financing of long-term assets. In Gauteng, people simply use credit to finance consumption, to keep going. And there is a tremendous reluctance to buy a house, to start a business. And I think it has to do with this big problem we have in terms of failing municipalities. The decision to undertake economic activity is not just a function of the economic cycle, of inflation, of interest rates. It's also about where you find yourself, where you live, and what faith you have in the local government to create an environment that is conducive and safe and predictable and efficient. So there's a whole bunch of additional risk that businesses and individuals are bringing into the equation when they consider whether they take out credit or whether they start a business.
Yeah, agreed. Very good points. Nicky, the other interesting thing, which I'm sure people will be interested to hear your views and comments, is on the global geopolitics and our friend President Trump as well. We watched a few nights ago him present his State of the Union address, which I think was 1 hour and 48 minutes.
The longest
in his true style.
History, yes, a record.
Correct. So South Africa, without a doubt, I mean, we're a relatively small-ish economy on a global scale, but certainly an open economy, and we're trading with the rest of the world. But that does make us exposed to global trade and geopolitics issues. And we've seen, of course, South Africa's sometimes alliances with China, Russia, Iran perhaps being spoken about in the press, which is not that aligned to the US, etc. How do you see South Africa's growth outlook just in terms of our exposure to global external shocks or risks in terms of how that may play a role in terms of our domestic economic growth and our policies?
Yes, indeed. I mean, it will play a role. It's affected the whole world. The interesting thing is, despite 2025 being the year of the tariff and incredible tariff uncertainty as well, remember that it changed. It was ever changing. The bad news is it's still changing. The US Supreme Court ruled against the so-called reciprocal tariffs that were brought under a provision called IEEPA, which is the International Economic Emergencies Act, that gives the US president certain power to impose tariffs without, well, not to impose tariffs, but powers to act with economic measures in the case of an emergency, right? And the Supreme Court ruled it was not an emergency, and the power to tariff was not among those powers, right? And so all of those reciprocal tariffs have now been ruled illegal, and they fall away. And the outcome now is South Africa, who did not manage to close a trade deal with the rest of the world, really kind of benefits. We now on the same 10% tariff than everybody else. We're still part of AGOA. AGOA has been extended to the 31st of December for this year. So on that score, we might actually do a little bit better than we thought. But I think what's going to weigh on the world economy as a whole is you still have that tariff. It is still much higher than it would have been, and it's going to keep changing. Because it now seems apparent, especially after that State of the Union address, they're going to look for means and ways of, again, imposing higher tariffs. And so that uncertainty, I think you're seeing it weigh on selected portions in the market. It's certainly weighing on the value of the dollar, which partly is contributing to the rand's resilience, and contributing certainly to the very high levels of gold price we've seen. But the reality is that that is still going to be a factor that's going to weigh on us. And I think government reflects that. That's part of the reason why you don't have a fast acceleration in growth. It's not just that we still haven't resolved all our infrastructure issues. It's also that the global environment is probably not going to be as supportive over the next 3 years in any case than it had been prior to 2025.
Nicky, I think we've got time for one more question. And I also think it was something that came out of the budget, perhaps for the first time, and pretty important. And that was the finance minister spoke about what he's calling the fiscal anchor. And I was reading an article and I thought it described it quite nicely. If you think of the Reserve Bank, where they've got now this inflation target that used to be 3 to 6%, now it's more the 3% level. That, in a way, is the Reserve Bank anchor. And now the government is creating this fiscal anchor for areas that are government affected. So as an example, they might put a rule in that the debt ceiling can't go above a certain amount, or they can't increase expenditure by greater than a certain pace each year, etc. So again, my view on it was it's probably a step in the right direction, but would you just share with us your comments around this concept of a fiscal anchor?
Well, it's been shown to work in the rest of the world, where it has been adopted. Very many countries are extremely reluctant to adopt it, because as governments like to spend, and the fiscal rule restricts you from doing that. In the US, they have something similar in the so-called debt ceiling, all right, which there is a prime example of how it's failed, right? Because their public debt has exploded to over 100% of GDP. Debt service cost is growing very, very rapidly, and they're still spending, regardless. So it doesn't always succeed, but it depends on how you phrase it and how you put it down. And we'll get the details of that in the October-November mini budget this year. But what I think government's going to go for is a proportional one that says that you can grow spending, but only if you can fund it. So if you want to increase, as a particular department wants to increase spending, you've got to show how you're going to fund it. And if you cannot fund it, then you cannot grow it. So I think that might be that sort of what you do with expenditure relative to revenue, tying the two together. I think that might be what they would prefer to go with.
Great. Nicky, I think that brings us to an end of our discussion today. Thank you so much for making the time and explaining everything so simply and nicely in the way that you always do. I think for people that are online and listening, just in conclusion, I thought perhaps I would quickly give 4 other points from the budget that are less, I guess, macroeconomic and more just pertinent to investors or financial advisors that might be dialed in. And very briefly, just to be aware that, first of all, in terms of the annual tax-free allowance, that's been increased from 36,000 Rand to 46,000 Rand per person. So please take advantage of that. Note, however, that the 500,000 Rand lifetime limit has not been changed as of yet. Also, in terms of the annual offshore allowance, where it was pretty simple to take out R1 million per year per person offshore directly, that amount has actually been increased to 2 million Rand. So for people who are looking to take money offshore into direct offshore investments, be aware that the allowance now has actually increased quite nicely. Also, in terms of one's retirement fund contributions, the limit there has been increased from an amount of 350,000 Rand to 430,000 Rand per year maximum amount. So please be aware of that. And again, definitely something to take advantage. And then lastly, I think quite an important thing that was also announced in the budget was the tax treatment on collective investment schemes or unit trusts, as we know them, as well as retail investor hedge funds. And this is a growing part of the industry. And what the finance minister announced is that these structures will be treated all as returns in terms of capital, and there's not going to be any distinguishment between interest, dividends, and capital that previously you had to display or show in your tax returns or a client statement. So again, I think this is a simplification and a positive development. So those, I think, are 4 key important takeouts from the budget yesterday. And that basically brings us to an end of our discussion for this year on the budget as presented yesterday. Again, I'd just like to say a massive thank you to Nicky and to everybody that's dialed in and listening, and that we hope that you found this really, really useful. So until next time, next year, looking forward to having you back, Nicky. May everybody have a great rest of the day. Thank you.